Good evening. I hope you all can hear me. Uh, shall we start from the first question? And if you all have any question, you all can talk to me through the chatting option. So the first question is about what is an entrepreneurial opportunity. So in the lecture we have discussed what is entrepreneurial opportunity. And it is any idea that has potential to create value. If someone has an idea that is commercially worthy, has potential to create value, then it is considered as an entrepreneurial opportunity. So, entrepreneur can create value by either introducing entirely new product or new service, technology, or it can be a different way of organization, like it can be an online platform for a business. Likewise, it can be an entirely new thing. It can be entirely new product, service, technology, or type of businesses, type of organized business organization. Or they can create repositioning or repackaging of existing products. They can reposition or repackage existing products to a new market or new set of customers. Let's say, even though it is not a venture, startup business, let's take, for example, this Zoom. So it is normally used for meetings for corporate sector, right? But now it has completely have new market, educational institutes. Educational institutes, now we are using it for conducting lectures. So the same product, entirely new market. Likewise, if anyone can create a platform, online platform that can do lectures much easier than the Zoom, then it will be a good entrepreneurial opportunity. Right? So it is kind of a repositioning to new set of customers or entirely new market. And so most of the successful ventures, they have normally ordinary ideas, but these ideas should be well executed in order to be a successful startup business. Right? So entrepreneurial. So up to now we have discussed that entrepreneurial opportunity is any idea that have the potential to create value, and it can be either entirely new product, or we can reposition or repackage the product. And the second part of the so is there any problem in the sound? Now, is it clear? So, you all mean there is no problem in sounds? It's clear. All right. Thank you. Then, in the lecture, you all have learned that there are many sources of entrepreneurial opportunities, right? So you all have learned it can be a societal trend, so it can be a demographic trend, it can be a technological trend, or it can be a crisis, or it can be a bubble, right? The entrepreneurial sources of these entrepreneurial opportunities. Actually, we can categorize these sources of entrepreneurial opportunities into two, as mega trends and fads. Right? These entrepreneurial sources of entrepreneurial opportunity can be categorized into two, fads and megatrends. So megatrend is like a long-term changes in society, demography, or technology over the time. long-term changes in society, demography, technology over the time is considered as a megatrend. So normally these megatrends are very slow in forming and they will slowly build over the time. But once it is in a place, then it will continue for a long time. So these megatrends will be slowly forming, but there will be these megatrends, there will be in for long term, for long time. When it comes to fads, those are very short term changes in society, technology, and demography. Right? Short term changes. So the main difference between the megatrend and fads is the time horizon. So megatrend is a long-term change, fads are short-term changes. And fads are very non-predictable things. So we cannot predict. It will suddenly occur and it will continue for a short period of time. So now have you understand the difference between the megatrend and fads? Okay. So you'll have to reply through the group chat. Right. Then you'll have to identify and explain one fact and one megatrend currently prevailing in the Sri Lanka, giving major business opportunities. Right. So what are the long-term trends that we can see in Sri Lanka? So actually there are many long-term trends. Uh, it can be a societal change or it can be a change in demography. Right? So let's say when it comes to changes in demographic changes, right? So when it comes to say problems like aging population, normally in Sri Lanka it is predicted that by 2030, 30% of Sri Lankan population will be aged more than 60. So the aging population is a kind of mega trend now. So in future there will be an opportunities to cater to these people. So healthcare products, healthcare services, nutritional supplements, and any medicines related to elders, those will have high demand, and there will be opportunities for people to produce such products, healthcare products, to facilitate this aging population. Or if we take the environmental changes, so most of people now prefer for recyclable products, reusable products at lower cost, or energy saving products like that. So in simple terms, so we are preferring green products. And when it comes to societal changes, so now most of the people are working. So both parents are working. So childcare services, high quality childcare services are also in demand. So you can study the market and uh, suggest any long-term change, then it will be a mega trend. And when it comes to pets, it should be a short-lived change. Like, say for example, this health problem, this pandemic, if it is short-lived, I don't know whether it will be a short-living thing or it will last for more than 1 year. So if it lasts for less than 1 year, then we can consider it as a fact. So then these face mask businesses and all those things, hand sanitizers, producing hand sanitizers like things, will become a fad. And so most of the time, these clothing fashions, then these mobile games are fads. So for a certain period, some mobile games are very popular. So after some period, we even don't know which uh, games exist. Right? So the mobile games, clothing, the fashionable items are most of the time are considered as fads. For certain times, those are very popular. So after some times, uh, we don't know even they exist. Right? So I hope you all have understood the mega trends and fads, uh, and you should be able to identify the prevailing mega trends and fads uh, in Sri Lanka and even in international context. Right. So moving on to the second question. So if there is any problem with my pace, I mean, if I'm talking too fast, you all can tell me. So I hope this pace is okay with you all. Uh, so moving to the second question, explain how each person would make decision under the following scenario from the perspective of principles of entrepreneurial finance. So principles of entrepreneurial finance, we didn't discuss in the lecture. So I will explain what are the principles of entrepreneurial finance. If you have read the reference chapter that we have already uploaded to the LMS, you will find these details of the principles of entrepreneurial finance. So actually, entrepreneurial finance, it is a combination of both finance, the concepts of finance, and the entrepreneurship. So, combining these two areas, there are 7 principles in entrepreneurial finance. 7 principles. So, the first principle is real, human, and financial capital must be rented from the owners. Real, human, and financial capital must be rented from the owners. That is the first principle. So that means, so in order to start up a business and continue the business, entrepreneurs need real assets like buildings, machineries, lands, right? And apart from real assets, we need financial assets, financial capital, funds to start the business and run the business. And then entrepreneurs need human capital, the people, workers, labors of the, at least if we don't hire someone else, the labors of the owner, right, should be used for business activity, right? So, so we need real assets, financial capital, and human capital to start and continue the business. So all these capitals should be rent out from its owners. Right? So that simply means there is an opportunity cost for all these 3 assets: real assets, financial assets, and human assets. And so if we take a real asset like a building or a land, there are many other users for that asset, right? So if it is a land, it can be used for business, it can be used for plantation. So when we use that for our business, we have to pay a rent for the owner. And when it comes to financial assets, so basically, if we do not consider the risk factor, at least as a minimum payment, we have to pay the time value of money. Right? So that is the minimum rent for financial assets, providing funds. So if it is a real asset, we should provide a fund to compensate the opportunity cost. And even for financial assets, as a minimum payment, we should pay for the opportunity cost, which is the time value of money. And for the labor, for human capital, we need to pay a fair wage as a rent for labor. So venture has to provide fair return to its. So this principle simply means so venture has to provide a fair return to its resource suppliers. Right. Then the second principle is risk and reward go hand in hand. Risk and reward go hand in hand. So simply we know cost of financial capital is much higher than the time value of money because of the risk factor. Up to now you have learned about the cost of equity. The last lecture you have learned about the cost of equity and debt. So we know there is a high risk uh, in the venture. So higher the risk, higher the expectations of return. Not the return, higher the risk, higher the expectations about the return. So that is the second principle. Risk and reward go hand in hand. Higher the risk, higher the expectations about return. So up to now, I hope you all are clear. Then third principle is accounting is the language of the business. Accounting is the language of the business, while cash is the currency. Accounting is the language of the business, while cash is the currency. So that is the third principle of entrepreneurial finance. Accounting is the language of business, while cash is the currency. So why we need a language? So basically we need a language for communication purposes. So if we need to communicate the performance of the business or the financial states of the business, then we have to use accounting as the language. So using accounting principles, techniques, standards, the business entrepreneurs can prepare financial statements like income statement, balance sheet, cash flow statements. They can prepare the financial statement. Then these statements will help them to accurately communicate the performance and financial status of the business to the community, mainly to the business community. Right? So using accounting principles and standards, entrepreneurs can prepare financial statements, and entrepreneurs can use these financial statements to communicate their performance and the financial status to the business community or to any interested party. And normally, accounting for a startup firm have two purposes. Accounting for startup firm have two purposes. One is the tracking the firm activity. So the first objective or the first purpose is tracking the business activities. And then the second purpose is quantifying the future. So that is the important aspect of accounting for a startup firm, quantifying the future. So that means when a startup firm approaches to the latter stages of the life cycle, so when they come to a like development stage, when they come to like a growth stage and maturity stages, right, they need to quantify the future to obtain like to obtain finance. Like if they want to apply for a bank loan, then they need to provide these financial statements to quantify the future, to show the venture's ability to generate cash. or even to have the performance evaluations like break-even analysis, or to calculate the value of the firm, uh, venture needs this financial information. So counting of the startup firms have two purposes: tracking the firm's activity and quantifying the future. So when it comes to the latter life cycle stages, so quantifying the future using these accounting statements is important. And the second part of the principle is cash is the currency of a venture. So for a venture, the main daily crisis is about cash. Whether a venture has enough cash to pay their daily bills. So that is the main problem for venture. So counting measures that is focusing on cash is pretty much important for entrepreneurs. Like so we have learned the measures like cash burn, cash build, net cash burn, and cash burn rates are very important, and the cash budgets, preparing cash budgets are very important for ventures because their main problem is liquidity, is cash. Then the fourth principle is new venture financing. New venture financing involves search, negotiation, and privacy. New venture financing involves search, negotiation, and privacy. Right. So now you know there are two markets that business can approach to search for funds. So one is public financial markets and other one is private financial markets. So if we want funds, so if businesses want funds, they can either approach for public financial markets or private financial markets. So normally in public financial markets, they are organized platforms and they have standard securities like bonds and shares. And those public markets are very liquid, right? So if we want to buy shares, we can go to the share market and buy. So if we feel like that company is not performing well, we can sell the shares, right? So we can easily buy and sell securities in organized platform in the public financial market. Therefore, this trading prices it reflects the true value of. We consider that it reflects the true value of the company. Therefore, we believe that there is an informational efficiency in public financial markets, right? Because we can easily buy and sell. There is active trading in the market. But as you already know, ventures cannot approach for public markets initially. So they have to find the funds or their investments through private financial markets. So when it comes to private financial markets, so that means venture owners, they have to actively search for funds. They have to actively search for different finance providers. And when they find a potential investor, they have to negotiate the terms with them. So in a private financial market, there are no standardized securities. So you have to find an investor. Right? So that venture owners have to actively seek the fund providers, and when they find a potential investor, they have to negotiate the financial terms with them. Right? They have to negotiate. That is mainly because once the deal is finalized, when the investment is finalized, it is for a long term, at least for 2-3 years minimum. Minimum it is for 2-3 years. So since these private financial markets are not liquid markets, right? They cannot uh, sell their equity share easily, right? So both parties, entrepreneur and investor, they will be locked in that agreement for a long time. So if there is a financial agreement between the entrepreneur and investor, that agreement will be for a long term, and both parties will be locked in that agreement for a long term period because of the illiquidity of the market. Right? Therefore, in private markets, when new ventures search needs financing, they have to search it in private financial markets, and they have to negotiate and make suitable terms with the finance providers, with the investors uh, for their financing. So that is the fourth principle. New venture financing involves search, negotiation, and privacy. And these agreements are private agreements. It is specialized or customized to that particular venture. Then the fifth objective is venture's financial objective is to increase the value. Venture's financial objective is to increase the value. So that means like entrepreneurs, they can start their venture for many reasons. Like there can be economic reasons, or they can start ventures due to their personality, their characteristics, like uh, they like innovations, to be innovative, and they like to take challenges. uh, some of their characteristics that they don't like to work under someone else, right? Or there can be social objectives, like they want to provide employment for the local people. Or there can be even environmental objectives, like they want to produce like alternative products, environmental friendly products. But when it comes to financial objective, it is none other than creating value. So there can be many other objectives for venture, but when it comes to the financial objective of the venture, it is to create the value, to increase the value. Because at the exit point, uh, this value of the firm will become the wealth of the owner. Right? At the exit point, either venture can be sold to another party at their fair value. So, if the financial target is to increase the value, it will ultimately convert to the venture owner's wealth. Then, so up to now, have you all clear with these principles? I have explained 5 principles. So, do you all have any problems? Yes or no? So, give me a simple answer. So, the sixth principle is it is dangerous to assume that people act against their self-interest. The sixth principle is it is dangerous to assume that people act against their self-interest. So it is the human nature that all people are self-interest. We are greedy, right? So therefore, interest of the owners, investors, debtors, or managers should be carefully aligned. So that is the meaning of this sixth principle. So people won't act again. People won't act against their self-interest. Therefore, it is important to align the interests of the owners, investors, debtors, and managers. So, venture owners should be very careful in preparing financial arrangements and operational arrangements because they need to consider the self-interest of the parties involved in the arrangement. Right? And so once there is arrangement and after a certain period of time, and if the circumstance or the condition is now changed, then these operational or financial terms of the operational or financial arrangements should be renegotiated. Right? It should be renegotiated because venture need constantly monitor these incentive alignment to avoid the agency conflict. Right? So when venture preparing financial and operational arrangements, they should be carefully consider about the alignment of the interest uh, of the parties that are involved in these arrangements, and these terms should be constantly monitored, and if there is any change in the condition or a circumstance, then these terms should be renegotiated to avoid the age conflicts, right? So there can be owner manager conflict, or there can be owner debt holder conflict. To avoid these conflicts, we need to constantly monitor these incentive alignment. Then the final principle, which is venture character and reputation can be an asset or liability. Venture character and reputation can be an asset or liability. So normally when it business character means how the individuals in the business or the entity behave, how the individuals and the entity will behave. So whether there is on-time deliveries, on-time payments, and appropriate email etiquettes, quick responses to the complaints, and honest responses to the customers, uh, then following laws and regulations. Likewise, those things are considered as business characteristics, right? The character of the business. So, having a high ethical standard is a must for business, especially for a venture. Right? Having a high ethical standard, which goes the good business character and reputation, is a must for a venture because it is one of the main reasons for the long-term success of a business venture. So having a good reputation and character and high ethical standard is one of the most factors uh, for a long-term success for a venture. So sometimes at the very early stages, character of the business and the characters of the owner it can coincide since the owner represents the business. So most of the people think the characters of the uh, owner is equal to the character of the venture. But having a good reputation is important for a venture. Even for the financial objective of value creation, it is very important having a good reputation and character. So having responsible marketing and selling practices all will make it easy to create value. Right. So, so I have explained the 7 principles of the entrepreneurial finance. So if you need any clarifications or area which is not clear, you can tell me through the group chat. And if you'll have understood, can you attempt on the question number 2? So I will give you like 2 minutes. So I have already asked you to attempt on the questions. So I hope at least you will have read the questions. So I will give you like 3 minutes. Can you all attempt on the question? Yes. Here, in the context of this entrepreneurial finance, incentives means the interest of the fund providers or the managers. So incentives and interest means the same. Right. The first scenario is Savindu, who is a young entrepreneur, have 100,000 rupees to invest for 1 year. He can earn either 14% interest rate for 1 year at ABC Bank or 15% interest at JKL Bank. So what would be his choice? So it is a very simple choice, right? Obviously, anyone would select the interest rate with high interest rate, right? Because if you invest in ABC Bank, you will get a return only 14,000, and if you invest in JKL, he will receive 15,000. And since it is not mentioned about the specific risk characteristics of the banks. So we can assume both these banks are at the same level. The risk level is same. So when the risk is same, always we prefer as investors for higher return. Right? So if both these banks are commercially a similar type of banks, then we would prefer investing in JKL Bank, which has the higher interest rate because it provides the high return. So it is the second principle, right? Risk and reward will go in hand. So higher the risk, higher the expected reward. So as investors, if the risk factor is same, we always prefer for higher return. Then the second option, the second scenario, can you all tell me what is the principle relevant for the second scenario? Can few of you give me the answers through the group chat? Just the number of the principle? Five. That means venture's financial objective is to create value. And there is one suggestion, seven. That is venture character and reputation can be asset or liability. Right. Here is also we have and investment opportunity where we have 3,000 rupees and there are two investment options. One option is it will repay 2,700 or 3,300 at the end of 1 year, depending on the success of the venture. So that means if venture becomes a success, you will receive 3,300, or if it becomes a failure, then you will receive 2,700. And the second investment either would pay you 2,000 rupees if it fails, and if it is a success, you would receive 4,000 rupees at the end of 1 year. So depending on the success of the venture. So which investment should you choose? So when you are choosing investments, it is all about risk and return, right? So this is also an example for the second principle, where the risk and return will go hand in hand. Right? Here, if we take this example, you can simply calculate an expected value for the two scenarios. For investment one, the first investment, and for the second investment. Right? So if we take the probability of, let's say, for example, if the probability of success is 50% and failure is 50%, or even you can take just an average value, right? So the expected return would be here 2,700 into 50% plus 3,300 into 50%, it would be 3,000 rupees, right? And then for the second investment option also, 2,000 and into 50% and 4,000 into 50%, it would be again expected value would be 3,000, right? So both options have same expected value. Then in selecting the investment, we have to look for the risk factor, right? So normally risk is reflected in the dispersion of the outcome, right? So here if we take the low result and high result and the dispersion in these results, at first investment 2700 is the low result and high result is 3300, and when it comes to second investment, low result is 2000 rupees and high result is 4000. So it has the high dispersion. The second investment has the higher dispersion, which means it has the higher risk, right? So second investment we can consider, it can be considered to be riskier because it has the high dispersion. Therefore, when the investment amount is also same, so we are only investing 3000 rupees and expected value is also same. Then as risk averse investors, we would always select an investment with lower risk, right? Which means in normal condition, we would select the first investment. Okay? So this is about the second principle of entrepreneurial finance. But uh, since this initial investment amount is very small, and since it is only 3000 rupees, if you like to take risk, you are like an investor who like to take risk, then you can select the second investment. But at the normal condition, we would select the first investment because with the same initial investment and same expected return, so normally investors are risk averse, right? We would consider the normal behavior of investor is risk averse. So risk averse investors would select the first investment. Okay. So now have you clear with the concept? The second scenario. We are clear with the second scenario. Right. Then moving on to the third question. So this is also relating to the one of the principles of entrepreneurial finance. So assume that you have been working on a first generation prototype for a new product. An angel investor is waiting in the wings, wanting to invest in the second generation model or prototype. Unfortunately, you have run out of money and aren't able to finish the initial prototype. The business angel has previously said that she would walk if you cannot produce a working first generation prototype. Then what would you attempt to do to save your entrepreneurial venture? So considering the principles of entrepreneurial finance, what would you recommend? So now tell me what will be the relevant principle to this scenario? So tell me the number of the principle relevant to this scenario. Nine, six, four, to the first principle, the most of you all have suggested, 4. The new venture financing involves search, negotiation, and privacy. Right. Then the principle 6 is about aligning the interest. But this situation is about so this person or the entrepreneur has already found an angel investor, right? So he is not principle 4. Principle 4 is about finding uh, an investor. So he has already found an investor. But here the problem is an ethical problem, right? So investor has agreed to provide further funds if you can generate a working prototype, first generation prototype. But you aren't able to do that, right? So now you have run out of money, therefore you cannot produce an initial working prototype. And what would you do? It's like what would you do to secure this investment? What would you suggest? So it is most likely an ethical delay, right? So normally it is about the if it is about ethical dilemma, then it is related to the seventh principle. It is that venture character is important for a long-term success. And that means if you tell a lie, then it will be a problem. So if you tell that this you haven't produced an initial prototype, then you will lose the funds. So that is the problem here. So considering the seventh principle, you can suggest, because the ethical standard is pretty important for a long-term success, it is a critical factor for a long-term success in a venture. So normally, first what you should do is, what you can suggest is being honest with the fund provider, with this angel investor, being honest and inform with that you have run out of money, therefore you cannot finish, you couldn't finish the prototype. So if this investor walks out of the investment, then you have to search for a new fund. So then you need the fourth principle, where you have to provide, you have to search for new funds. But with the given scenario, it is an ethical dilemma whether to tell a lie and have funds or whether to tell the truth. But if you tell a truth, that will be a problem for a reputation. So therefore, according to the seventh principle, being honest is important for a long-term success. So therefore, the most proper course of action is telling the truth, whether you haven't finished the initial prototype. Then, of course, you need to find more funds to secure. Then you have to secure the financing arrangements to complete the initial prototype. Then you have the next scenario where you have already lied. So now let's assume that angel investor will advance you the financing needed for the second generation prototype based on your word that the first generation prototype has been completed and is working. What would you do? Now you have told a lie to the investor. So that means that the confidence and trust that the angel investor had about in you, now will be broken. So it will be very difficult to continue the working relationship. And If you continue it for a long time, then it will be very difficult. You will have a bad reputation and it will be very difficult to obtain funds in the private market. Because most of the time these angel investors are networks, is a set of wealthy individuals. So they have connections. So therefore, if you had done something like that for one person, other people will also would not provide funds for you. Therefore, always we recommend to be honest. So that would be the best option for both parties, both for investor and for entrepreneur. Telling the truth is the best option. Otherwise, it will ruin the working relationship and your business reputation, the reputation of the venture, and finally your venture will become a liability to you because you couldn't find funds for the venture. Right. So it can be very tricky if we give a scenario, and you should be very carefully analyze what is the relevant entrepreneurial principle for the scenario. So now you will have understood that this situation is related to principle 7, or still you all have doubt. Now, give me a quick response whether you have understood that the situation is about principle 7, or you all are still do not agree with me. Then shall we move to the next question? Uh, so I have given you several concepts related to entrepreneurial finance or the business ventures. So then I will explain the concepts. Have you all familiar with these concepts? Business incubators, seed accelerators, factoring. So factoring, you all must know what is factoring, and receivable lending, bootstrapping, crowdfunding. Are you all familiar with these terms? Yes or no? I will explain the concepts. Don't worry. Right. Business incubators means that actually I have told you earlier, most of the business ventures they fail uh, mostly not because of bad ideas. They have good entrepreneurial opportunities. They have very good ideas, but the execution of these ideas is not good. So that means they don't have business management skills. So they don't have much skills about. So most of the entrepreneurs they are very innovative and their thinking is very good. But when it comes to managing the resources, they are not very good, right? So business incubators are normally an organization. They will provide help to the startup companies to develop. Right? They will provide help to startup companies uh, to develop by providing uh, instructions about management, operations, and financial services. So they will help entrepreneurs to develop management. They will provide marketing assistance, and they will help them to prepare the financial statements, and even they will help them to obtain private funds, even loans. Right? So business incubators are the organizations that will help startup companies to develop their management, their marketing strategies, and to prepare proper financial recordings, to obtain funds from private markets or to obtain funds from bank loans. But they will not invest in the venture, right? They won't be investing in the venture, but they will help venture to develop, right? So that is what business incubators will do. They will help the startup companies to develop. They will provide the advice of to manage the business, about operating activities and about the financial services, but they would not invest in equity. Right? When it comes to seed accelerators, they are also like business incubators. They are also organizations that usually provide uh, the mentoring services, educational aids for success of business. Right? So business incubators are and seed accelerators are doing the same job. Like they are supporting entrepreneurs, they are supporting startup companies to develop. But the difference is seed accelerators, they will provide equity to the ventures. Apart from the mentoring and educational aids for success of ventures, seed accelerators would provide equity funds. Right? So now you know the difference between business incubators and the seed accelerators. Business incubators will also help companies to develop their management skills and their marketing strategies and any other operational and financial services. They would provide help, but they would not invest in the venture. So when it comes to seed accelerators, they will provide help to the business, to the venture. Apart from that, they will provide equity funds. They will be investing in the venture as well. So are you clear with the first two concepts, business incubators and seed accelerators? Let's just quickly respond yes or no. Right. Then factoring. Then the third concept, factoring. So factoring is, you all know what is factoring, right? A firm or a venture can sell their receivables at a discount value. Right? So if the receivables value is like, let's say you have a receivables worth of 200,000, but you can sell these receivables to a third party at a discount from their face value. Now your worth of sales is 200,000, but you can, let's say you can sell it to a third party at 170,000. Right? So 30,000 discount. So venture can sell the receivables at a discount value to a third party. So venture can quickly obtain the cash. Now third party has to collect the funds from the receivables, from the debtors. Right? So, so as you know that ventures most important aspect is obtaining cash quickly. Right? So therefore factoring can be used for that purpose, where the venture can sell their receivables at a discount price for third party. So actually then they won't be having then the venture don't have any problems related to the collection of debts, right? And the most important thing is they can obtain cash quickly. Rather, they don't have to wait for some period. Right. Then, so that is what we simply call as factoring. Then receivable lending is like factoring, but there is a difference. Receivable lending is venture can obtain a traditional debt. Let's say venture can obtain a bank loan, making receivable as a collateral to the loan. Venture can obtain a bank loan, making the receivables as collateral to the loan. Right? So what is the major difference between the factoring and receivables lending? So in factoring, venture sells their receivables. Right? They completely transfer the ownership of their receivables to some third party. Right? But when it comes to receivable lending, venture use their receivables to pledge them as a collateral in receiving lending. Right? So venture will pledge their receivables as a collateral to obtain loans. Most probably the traditional loans like bank loans. Right? So factoring is all about selling the receivables to third party at a discount value. Receivable lending is about obtaining bank loans, making the receivables as a collateral to the bank loan. Right. So now you all have understood the factoring and receivable lending and the difference between factoring and receivable lending. Yes. Quickly tell me yes or no. Then I will move on to the last two concepts, bootstrapping and crowdsourcing and crowdfunding. Right. Lamai, let's say this bootstrapping, can you change it as it has financial bootstrapping? It should be financial bootstrapping, right? And the final two should be EF, right? A, B, C, D, E, F. So bootstrapping, changed it as financial bootstrapping. So financial bootstrapping means it is creative ways to minimize need of financial capital. Right? So when an entrepreneur creates a new venture, so he needs financial capital, but it is very difficult to find capital in private equity market. So therefore, if we can minimize the need of financial capital, that will be very helpful for the entrepreneur. Right? So any innovative and unique ways of minimizing the need of financial capital and unique ways of financing is called as financial bootstrap. Let's say, for example, so if venture needs lot of investments in physical assets, then looking for innovative options to reduce the investment in physical assets can be considered as financial bootstrapping. Right, and any innovative ways to reduce the expenses, like venture can have an agreement with their employees that they can work at the initial stages of the venture, initial life cycle stages of the venture without taking salaries, but at the latter stages, they will be providing salary plus the equity ownership. The arrangements like that, and they can have negotiations, the ventures can have negotiations with the suppliers to get discounts on their materials or some or things like that, right? So any innovative or unique ways to minimize the need of financing capital or unique ways of financing can be considered as financial bootstrapping. And then crowdsourcing and crowdfunding. Actually, these are two concepts. Crowdsourcing and crowdfunding is not the same thing. It is different thing. Crowdsourcing means uh, obtaining information or input to some task or project from the public. Let's say, for example, in the venture context, like you have a initial idea for product, or you have produced a product, and you will give the information about the product to the public, to the general public, let's say via internet, right? And you can ask suggestions to improve the product, right? So that is called crowdsourcing, obtaining information about the product or some project or some task from the public. So it can be through internet or whatever the medium. That is called crowdsourcing. So sometimes crowd will provide more insights to develop the product, right? And they will provide their response much faster. So it will help the entrepreneur to reduce the length of the new product development time. So it will reduce the time to market of the product. Right? That is what we mention or identify as crowdsourcing, obtaining information from the public. Then crowdfunding is financing the venture from the crowd, financing a venture by a group of individuals, simply through a crowd, financing a venture by a group of individuals. Normally, funds in Sri Lankan context, uh, normally ventures don't raise funds through internet, but when it comes to international context, uh, companies, the ventures are raising funds through internet. So which we is the main form of crowdfunding, right? So normally through internet, uh, the business will gather a small contribution from large number of people and collect a fund. Like there are donation sites, like pre-purchase sites, like even there are lending crowdfunding sites. Right? So these type of activities are called crowdfunding. Right? Obtaining the funds from a group of individuals or obtaining funds from the general public via an open call over the internet. Like if you don't have any other option of fundraising like angel investors or venture capitalists, we can try these crowdfunding options as well. So crowdsourcing is about uh, finding information from the public. Crowdfunding is about finding finance, finding the funds from public. So I hope you all have understood the bootstrapping and crowdsourcing and crowdfunding, the concepts. These are very simple concepts. The new terms, sometimes you might have learned the terms as well. And the fifth question, so debt financing is not advocate for entrepreneurial ventures due to its downside effect to the business. On the other hand, it is difficult for ventures to obtain debt financing, especially through bank loans. Briefly explain the reason for the above phenomenon. So now here in this question, there are two sides, right? The first one is that entrepreneurs don't like to obtain debt finance. On the other hand, the banks would also don't like to provide debt to the ventures, startup company. So what are the reasons? So you have to provide the reasons from the perspective of both parties. So I will give you like 2-3 minutes. Can you attempt on the question? Like, think of some reasons. So why would you think that entrepreneurs don't like to obtain funds uh, through debt from the side of venture owners? What can be the reason? Mainly that obtaining debt is a additional pressure to the ventures, right? So normally the interest cost is fixed. So whether we have generated enough cash to pay for it or not, uh, venture has to pay the interest, right? So that is an additional pressure, and there is some monitoring cost to this debt financing as well. And then if venture miss a payment or default in some other way, that would there will be some legal procedures. That is also a burden to the venture. So even though uh, debt have low debt has low interest or the low cost to the venture, it is an burden to the venture owners to obtain loans. So they can, sometimes they might have income, sometimes they won't have much income to pay loans. So therefore, from the uh, venture owner side, it is they don't like to deal with that problem. So equity is a natural fit, right? And from the perspective of banking institutions, from the perspective of banking institutions, banks, from their side, they also don't like to provide loans. One, the main thing is that most of the time at the initial stages, a large portion of assets in the startup firms are intangible assets. Like they have good ideas and they have skills. So therefore, the assets of they have a lot of intangible assets, not tangible assets. So these assets cannot be considered as a collateral for loans. Right? That is one reason why banks don't like. And if they have no history, if the venture has no history, then there will be that is also a problem. So they cannot guarantee whether they will be able to pay the loan value. Right? So if they have if the history of the business is it can be inadequate to provide loans, and uh, and the risk characteristics of the venture. So as we all know, the venture has high risk, right? So apart, especially the performance of the venture, it is depending upon the owner, right? So something happens to the owner, uh, he cannot be replaceable. So therefore, the risk characteristics of the new ventures are also one reason why banks don't like to uh, provide loans to startup companies. And in case of a default of a new venture, it is very difficult to collect the funds. It is actually not economically feasible to collect the funds from the banks, sorry, to collect the funds from the ventures to the bank. And as you all know, there is a high rate of business failures in the ventures as well. So therefore, from the bank sides also, they also don't like to provide bank loans to the startup firms. Then moving on to the final question, it is essential that the entrepreneur understand the various sources of financial capital needed as venture progress through its stages, explain the type of financing that typically coincide with each stage of a successful venture's life cycle, as well as the players associated with each type of financing uh, with each stage of the life cycle. Right. You all have learned there are 5 stages of venture life cycle: the development stage, startup stage, survival stage, rapid growth stage, and early maturity. And you will have already learned what are the characteristics of those stages and what we call the finance, the venture financing, the terms of venture financing, and who are the players. Right. So if we move on to the first stage, that is the development stage, so where the business convert its business idea to a viable product. So at this stage, you know, the feasibility of the business idea is put into trial. Right? So normally, the venture will produce a prototype, a trial service within this development stage, and the type of financing at the development stage is called seed financing. Right? The type of financing at the development stage is called seed financing. So who are the main players who provides the seed financing? Is mainly entrepreneurs own funds and own assets, and he can obtain funds from his family or friends. And then the financial bootstrapping techniques also can be used in the initial development stage, the innovative and creative methods to reduce the cost. Right? So the major source of finance is called the seed financing, and players are entrepreneurs' assets, entrepreneur and his family and friends, and the financial bootstrapping techniques. And then startup stage, so it is where the business starts to organize and develop their initial uh, revenue models. And at this stage, they will acquire the necessary resources, physical and intellectual resources, to begin the operations, and they will sell their first product. So at this stage, the financing method is also called startup financing. So it is the finance that need for initial production and sales. So the main major players in the startup stage would be business angels and venture capitalists. Apart from the earlier players, we can obtain funds from family, friends, and entrepreneurs' assets. Apart from that, from startup stage, we can obtain funds through venture capitalists and business angels. Then moving on to the third stage, the survival stage. So that is the stage where the revenue starts to grow, where some of the expenses can be covered through revenue, but still the expenses will be higher than the revenue. So at this stage, the source of financing, the financing is called first round financing. So some part of finances can be covered through business operations. Apart from that, we need funds from the venture capitalist, and we can have arrangements with suppliers and customers. We can get credit period from the suppliers, and we can have quick terms with the customers to pay quickly. And sometimes at the survival stage, uh, ventures can obtain funds from government assistance programs as well. So they can obtain funds from business operations, venture capitalists, from suppliers and customers, and government assistance programs mainly. And when it comes to the next stage, which is the rapid growth stage, so now the cash flows from operations, the revenue will be higher than the expenses. Uh, Now at this stage, the financing is called second round financing, or we can call it as a mezzanine finance. Mezzanine financing is especially the funds that venture would obtain for expansion purposes. If funds are obtained especially for expansion purposes, like for plant expansions, for marketing and product improvement, then it is called mezzanine finance. So mainly is debt. If we obtain debt for these expansion purposes, it is called mezzanine finance. And second round financing is called needs, working capital needs. Right? It is especially the funds we obtain for working capital needs. So normally uh, to the suppliers and creditors, and to business operations. And apart from that, if the venture is in rapid growth stage, they can approach for commercial bank loans as well. From the rapid growth stage, now they have bit of a history. Now they can provide their prospect to create cash flows, to create profits uh, to the banks. They will have financial statements to communicate that they can have a value or good. They have the ability to generate cash flows. So now they can apply for bank loan. The commercial banks, suppliers, and customers, business operations, and debt, other debt forms are the major players who provides the finance. And then it comes to early maturity. That is, the financing is called seasoned finance. At this stage, most of the time, that firm, it is the exit point of the firm. Either firm will be sold to some other party or they can go for a IPO. So at this stage, it is called seasoned financing, and they can obtain funds from commercial banks, and of course now they have the two business operations. Apart from that, investment banks also provide funds at this stage if you are going for an initial public offering. Right? So commercial banks and investment banks are the new players at the final stage of the life cycle of venture. Yeah. So I hope now you all are clear with the first lesson. So I have had few, apart from the lecture, you'll have, I think you'll have additional things from the tutorial. And most probably the next week also in the lecture time, I will be taking a tutorial, and I will be uploading a case study. So it will be a more of calculations. So it is better if you have attempted on the questions. Otherwise, it will be easy for both parties, right? Uh, so I hope you all have understood the today's tutorial. If you all have any questions, you all can raise now through the group chat. Otherwise, we would be finishing the session. Right. So now, can you quickly respond to me via group chat whether you have understood or whether you have any other things to be clarified? Right. So I hope others also agreed with Dasuni. So no any further clarifications. Right. So then I will be winding up the session, and next week also I will be conducting a tutorial. Right. Thank you.